Hi, folks. Welcome to Financial Fitness with Patrick, presented by Soaring Prophets. Again, folks, we have an exciting week ahead of us with trading. Just had some very interesting information in regards to the consumer price index that's put out by Mr. Jerome Powell. Obviously, folks, we are seeing a rally that we have not seen in the tech sector, in the NASDAQ, in the QQQs, ETF. It's kind of rip your face one off. We're going to jump in here very quickly into some of the charts. But first of all, I want to thank you folks for joining. You folks with your liking, subscribing, and sharing, we're getting some great traction with this right now. If there's anyone that you know out there that is looking to find really great financial content on macroeconomic things, please send this out to them, let them know. Because our whole business, like my little sign off always says, is that we're here to make some money together. And that's what I'm hoping to do. This, folks, diving right in. Obviously, we've got Jerome Powell comes out last week. We've seen the market rally off of that because the consumer is believing and the banks are believing that we are done with rate hikes. Is that real? Are we seeing that? Today, we just received the consumer price index that is saying that inflation is cooling yet again. I again, I beg you, I ask you, look around in your life. Are things getting less expensive or more expensive, or are they staying the same? What we're concerned is right now in the market is this simply an algorithmic exchange? So we've seen massively oversold conditions when we looked at the NASDAQ and the QQQ sector in many stocks over the last 3 months. Okay. We saw a peak in July and we've hit massively oversold conditions. And the market can stay irrational longer than you can stay solvent, right? That means that it can be silly longer than you have money to wait it out. But folks, we're going to dive into the charts here. And I want to go through some of the technical analysis of where we are right now and what we're looking at. Because we're reaching all-time highs again in some of these sectors. When we don't have the profitability, we don't have the margin. Like a great example of this is Tesla. Tesla, the souffle. And for those of you that are bakers out there or cooks, a souffle is this delicate, perfectly manufactured product that has to come in with all the right conditions. If it gets bumped, it gets bruised, anything, it's toast. It will literally fall apart and become mush. And this is where Tesla is right now. Elon Musk comes out 2 weeks ago, says that he's very concerned about interest rates. He's so concerned about interest rates on the Joe Rogan podcast that he's almost in tears talking about how difficult it is to land such a big business and the production of this. Then a week and a half later, Jerome Powell comes out and says, don't worry about it. Inflation's over. We can go back to the moon as far as equities prices. Tesla's going to be just fine because we're going to cut rates. But he didn't say that. We've talked about this before. Jerome Powell came out and said, we're going to be data dependent. And there is the potential that we'll raise rates if the data leads us that way. But the market is reading their own script. The market is saying, folks, it's over. They've got nowhere to go but down from here. Buy everything, sell your grandma, and put the money into the equities market, the stock market. The issue is that I don't think we're done. From Powell's meeting last week, we've seen bond yields fall. That's what's stimulating this rally, okay? And the reason is that you're borrowing. For those of you that are following, we should just call this the bonds experience, right? I should have a little suit on, maybe a pea shooter. But the bond market is controlling absolutely everything that's going on right now. And what we're doing is we saw a massively overbought fluctuation in the bond market, and we're seeing that pull back. These are cycles, right? I want to jump in and I'll show you a few things on the market here in regards to the charts. So first of all, here we are at the 10-year bond, okay? This is going back from May. And again, we saw this the other day, higher high, higher lows, higher high, higher lows, higher high, higher lows. This is Powell's meeting here. What do we see? We see a drop, and here we are today. There's two ways this can be. This can be a head and shoulders pattern, and we're going to see this drop down the length of this head movement. That is a technical analysis of this. Or is this going to be rebutted, and we're going to see a new higher high taking us back over that 5% range? When we look at this up here, this is your MACD indicator and your RSI indicator. These MACDs and the RSIs were so overbought. They were saying that through a technical process that we were needing these pullbacks. These are cyclical processes, folks. We've been overbought since back here. Okay. What we're seeing now is the pullback that is through technical analysis being overbought, right? We're seeing the pullback that will now go to an oversold regiment and we will move forward. The problem is that people are rallying into this. We are not ready to run back to all-time highs. This is the NASDAQ. This is the all-time high back here in July, okay, of this rally that we're looking at. We are approaching that. I have to ask you, where are we in the macroeconomic climate to be rushing back to all-time highs? We aren't there, okay? The other facet that's really playing into this is the dollar. That is a scary looking candle today. And the reason that occurred is, again, we saw the CPI, which came in cooler than expected. We were expecting a hot read on this. But since here, we have been massively overbought in these conditions. These conditions have to rectify itself. These are technical traits, right? Does it have to pull back and rush back up immediately? No. But this is now coming into an area of support. This is a high. This is a low, right? These areas here have been support in the past. This area here is the first barrier that will have to be broken. Why? Because we tested, pulled back, tested, pulled back, and then rallied through. So these areas, the dollar is coming into a lot of support. Well, what does that mean? Earlier today, when the CPI was announced at 8:30 this morning, the dollar was already expecting a softer read, right? So when the dollar expects that softer read, it's ready to go. The problem is that it's the big hedge funds, it's the big market makers that are taking that move and making money on it, okay? Where us retail guys are coming in is after the initial open in the morning. We have not seen a massive move down in the dollar in the market active trading session today. What's that telling us? It's telling us that the retail investors missed this move. So there's two ways this goes. Retail can either chase, they can jump in and try to buy now while everything is at oversold technicals, right? Overbought technicals. They're hitting this peak in the technical analysis portion, or they have to go back to base it on the fundamentals. And when we look around at the fundamentals do not fly to all in this market right now. Again, we're this close on that chart to the all-time highs of the market. Do you want to buy at the all-time highs or do you want to buy at the lows and ride to the highs? So this move, again, is about to face a number of restricting factors, especially when we start to put on some of the chart important factors. So first of all, let's take a look at the Bollinger Bands. And these bands show us basically an average of the expected move. The dollar is breaking through the bottom of this, right? Every time we have ever seen the dollar break through the Bollinger Bands, wonk. It's like an elastic band. It snaps it right back. So do I expect this to just snap completely right back? No, but this can trend slowly and continue us back up to that 5%. Let's take a look at the QQQ. Again, we are way up in the top of the Bollinger Bands through the negative of the Bollinger Bands into overbought. The MACD is overbought. We have green candles. We have green lights up here. We are ready for a pullback, right? So those of you that are sitting in this market short right now, this is a scary time for most people. We've seen kind of these rip your face off movements. But the problem is that retail didn't get into it yet. Retail now has got to position themselves into this, or are they going to sit on the bench? Retail is the last section to get into these types of movements, and we're at all-time highs. Folks, this move is ready for a pullback. It's already overextended, and we will have to see what's coming up next. But when you make your money in these massive movements, it's fantastic to be able to diversify your portfolio, right? From the stocks into something more like real estate. And I think that's a great segue to our next guest. Hey, folks, welcome to another week with Financial Fitness with Patrick. And we have a fantastic guest again. Leading off of where we were last week with Brandon Cody, we are joined today by Mark Baltazar from Peak Multifamily. And I'd like to bring him in here. James, if you can toss him up there. Hey, Mark, how you doing, pal?
Good. Thanks for having me, Patrick.
Absolutely. So, Mark, obviously, Peak Multifamily Investments. You're located here just a few miles down the road from us here in Canada, another one of the Canadian connection here on LinkedIn. And you folks are doing something really impressive within the real estate market and the REIT industry. Can you maybe tell our audience a little bit about, first of all, maybe what is a REIT, how you folks are doing it, and what makes you guys a little bit different in that space?
Yeah, so I guess the easiest way to explain it, I think, a REIT is, I mean, a lot of people are, so the REIT concept, I think, is becoming a little bit more familiar to Canadians and Americans alike, but it wasn't always. And it's still, in fact, still the opportunity for us is educating on what a REIT is and the benefits of a REIT. I think the simplest way to think of it is most people understand what mutual funds are, right? So where you invest in a fund or a mutual fund, and that fund essentially gives you exposure to a bunch of different stocks or companies, right? So maybe it's a tech fund and you have like, IBM in there, and maybe you have some Tesla. And so it's a variety. So it's a portfolio of stocks. So REITs, essentially, you're investing. So what it stands for is Real Estate Investment Trust. You're investing in a fund, but that fund isn't a congregation of stocks. It's a portfolio of real estate. And so it gives people the opportunity to invest in real estate without having to do all the hands-on work, right? So dealing with tenants, dealing with property management, fixing toilets, dealing with all the stuff that real estate operations, requires, you can get exposure to that and have real estate in your portfolio without being hands-on. So REITs allow you to do that kind of at the highest level. The other benefit of a REIT is like, okay, so for us, we're focused on multifamily apartment buildings, right? And so these are, mid-size apartment buildings, 15 to 25 units in the market that we're in, about $5 to $6, $7 million, depending. And so most people can't buy these on their own. And so what a REIT or fund allows you to do is to invest, smaller portions, let's say $10,000, and be a part owner of this portfolio of multi-million-dollar assets.
So, Mark, with what you folks are seeing with Peak in the new real estate market as it is, when we talked with Brandon last week, one of the things that he was, brought up in regards to the overall market is kind of in that realm that you're talking about, that 10, 15, 20, 30 unit apartment complex that might be becoming a little bit under pressure in the market, whether it be, especially in the States. This is where Brandon was talking. I know here in Canada, we've been flush with money in a different way. We've seen inflation rising. We've seen costs of housing absolutely exploding. And you folks established this company in 2017, you were saying.
So we started executing on this strategy, investing with investors in 2017. It was our first acquisition of apartment buildings. At that time, up until the beginning of this year, 2023, we would work with accredited investors on an apartment building basis, so almost like mini funds. Yep. And then in 2022, we decided to kind of launch a fund.
So are you seeing, when you're negotiating these deals and underwriting these deals, are you seeing that some of these units that are coming up right now, are you seeing that more of them are coming on the market, looking at the overall macroeconomic climate that we're looking at? Or again, this is what Brandon was saying out of the States, is that he's seeing deals that folks were able to get in years ago. They might have had, some money that had been gifted to them. They might have inherited all of these sorts of things, and they got into the real estate game. And then all of a sudden they realized that this is a little bit harder than, I'm just going to put somebody in the basement, or I'm going to put somebody into this unit. And they don't really realize the tenant factor and the work of self-management. And maybe you have some property management in place, but what that looks like. Are you starting to see some of these deals that are kind of having trouble? Are you finding deals that are starting to become more available in the market? What is the mid-level multifamily climate in Canada right now?
So I guess a couple things, a couple ways to answer your question. I think the first thing in terms of like running, as an independent or as, an individual running a real estate rental business, it needs to be run as a business first and foremost, right? So I think what you described is very common, and it's like, hey, I'll put, rental in a unit, or, whether you have a duplex, triplex, or an apartment building,
yeah,
you should be managed the same and managed as a business, right? There's a process, there's things that you got to do. And so if you manage it like a business, then it's more likely to perform well. If you manage it as a side gig or a hobby, it could still work, but your chances are a little less. So the second part to your question, I think, is deal flow, like what we're seeing. So in Canada, we are seeing more deals on the market. So on the market, meaning available for sale, whether that's on an MLS or private or whatever it is, but kind of more deals available for sale. The profile, interestingly enough, at least the ones that we're being exposed to, are not necessarily the mom and pops that bought 2 years, although we are seeing more of that bought 2 years ago, maybe at lower rates.
Mm-hmm.
Now that the rates have ramped up, a little bit of a cash crunch.
Absolutely.
Or maybe they kind of, working on a deal right now, at least kind of trying to acquire or at least connect kind of through our network to a buyer, a project that, had a ton of overruns, lots of costs, wasn't managed properly. Right. So now they need to sell. So you are seeing more of that right now. We've seen a lot of actually buildings that have been, owned for 25 years, 20 years, no debt on it. Now they're kind of starting to cash out, right? The benefit of that, actually, of having a free and clear building, is that the owner can put, seller financing.
Absolutely.
On it. So right now, that's a very appealing component to acquisitions, is seller financing.
So just a question on that, Mark. So when you're negotiating these deals, and obviously every deal is a little bit different, what are you seeing in the seller finance piece? What are rates that sellers are willing to hold at right now? Because again, one of the things that I've been pounding home for people is the bond market. Today we had the Fed out of the States. When we had the 30-year bond sale today, it crashed. Nobody wants the 30-year debt out of the United States. That's long-term national debt. That debt is what China buys, Japan buys, Europe buys. Nobody wants the US debt right now. And we saw the skyrocketing in the 30-year. And then we had the 10-year that is going to be a little bit more closely tied to mortgage rates. So when you're seeing these private deals where they're willing to hold back a little bit of equity in return for a return, what are those numbers looking like here in Canada right now?
So in the deals that we've been a part of, not acquired ourselves. So we also help on the brokerage side, help find, some of our clients' buildings as well. And so I've seen, so a client of ours just picked something up with 3.5%. Okay. 3.5%, 5 years, 75% loan to value. Very good. Wow. It's probably the best I've seen.
Yeah.
That's
free money.
Yeah. I mean, yeah. Cause that type of financing right now, like bridge financing, is going to cost you 8.5% to 10%, maybe more, depending. Right. So it's half price, even less, right? Like you're getting 75% off of financing costs right now. Right. I've seen it as high as 5.5%, right? So
how are you finding, so when you're underwriting your deals, how are you finding some of the larger institutions to deal with? Are you seeing that they're getting a little bit tighter in their lending requirements, or are you tending to go more private equity?
They're getting tighter. So they're definitely getting tighter. They're pulling back loans. You have to come in with more money right now versus 6 months ago, maybe 12 months ago for sure.
Is 75 pretty base for what you're seeing right now? Like, again, the 80% has been kind of the staple, and it's allowed us to run rates as high as we have, values as high as we have. But are you seeing them pushing back to that 75 and even 70, or how's that looking in Canada?
75 for sure. Like I know there was some stuff that we were able to get 80, 85 even in a a couple of years ago. We've refinanced since kind of into long-term finance, so we don't have that debt on it anymore.
Yeah.
but it wasn't uncommon, 80 for sure, easy to get, 85 even. But now 75, like you don't see much above 75, nor do you really want to, right? Especially right now. I mean, I think, I would say that I would say personally, I think there's more certainty today about where the rates are going to go than there was 6 months ago.
Right.
Right. So I mean, I think, the sentiment of longer for higher, sure, get it.
Absolutely.
Is it going to go up? I would bet against it going up, right? I think, but it could. Who knows? No one knows.
I agree with you 100%. I don't think that we're going to see the 2% run, that we've seen.
Yeah,
like we're at the top-ish. We're almost there planting a flag.
Yes.
What that plateau is going to be, I agree with you 100%. That's a great point.
So, so I think, you're underwriting in an environment that's still volatile. I think it's still volatile, like bond rates, as you mentioned, right? So we look at bond rates here as well, the Canadian marketable bond, the 5-year, the 10-year, because that's how longer term debt is priced, right? Using CMHC financing, right? Which is, doesn't exist in the US, but, exists here. And so because it's been so volatile, lenders, they need to know that their debt is going to be exited. They're going to get paid off at some point, right? And so the exit typically in the Canadian market, not for all, but for many, is CMHC insured financing. Mm-hmm. And so when the price of that long-term debt is kind of doing this, they don't know where it's going to land, right? So they have to be more conservative, and that's why LTVs are coming down.
Interesting. Okay. So Mark, I think that leads into a great question, is that how are you folks managing and mitigating risk right now with Peak Multifamily Investments?
Yeah. So good question. So, a couple things. So we're in the value add space. So our model is, buy a building that's not performing well, under, the income is lower than what potentially should be in that market. Because we're in the Ontario market, we do have to deal with, the landlord tenant board and, the Residential Tenancy Act, right? So there's lots of stuff, right?
Which is a nightmare. And for those of you in the States, it is such a broken system. Again, being a landlord myself, dealing with multifamilies, the landlords now, it is a huge problem. And, with what Mark's building and have built with these REITs, is that this takes that headache away from you. You're not getting the phone call in the middle of the night that the toilet doesn't work. You're not chasing Tim, the tenant, on the first of the month because, hey, where's the check, pal? I think it's fantastic. But these are all things that you have to take into account. And again, I apologize for interrupting, but they're massive. They're massive headwinds when looking into investing in multifamily real estate.
Yeah. So the value add model is based on, turning over units, right? Or turning over, as people move, you can kind of renovate and bring it up. We've never been, our model isn't to, push people out or kind of what we call renovictions, right? So that hasn't been our model for a couple of reasons. One, I think there's risk in that, and there's legal risk, and there are ways to do it. And the LTV does allow some form of it, but we haven't really had to leverage kind of that, that type of thing. So we do, rely on, natural turnover, also negotiation with tenants, right? So that is a win-win situation. So that rate at which your building turns over has slowed, right? And so that's in our underwriting, we've had to now take that into consideration. We've had to kind of turn that down a little bit. And so, so the buildings that we look at or end up kind of buying, then it has to go through that filter, and so there's fewer and fewer that make sense because, again, there's that risk, right? Now with seller financing, 5-year seller financing, right? That kind of releases a little bit of the pressure. Get kind of that stuff done. Also, bond yields, right? Like, so our takeout financing costs are estimated are higher, right? But I don't think anyone would have guessed that would be this high today. I mean, we didn't.
And again, where we land, right? But no, I think, Mark, you bring up a great point there. And for those of you in the States that are following this, in the area where Mark is, in Ontario here, we've seen rental increases of, 50-60% in the last 3-4 years. Our real estate values have arguably ballooned. I know that's a terrible way of putting that in the real estate market and call anything a balloon, but they've ballooned to a point of almost ridiculousness. And we're in a situation where we're trying to figure out what's next we've had these value adds that have been baked into the cake here for a fairly long period of time. And that's where, when I ask you about risk avoidance and trying to come up with an alternative in some of these situations, it's going to be, probably your biggest uphill battle for the next number of years. I see with looking at Peak Multifamily that you folks are looking at double-digit returns currently for your individuals. And maybe you can talk a little bit about what goes into that and how you folks are paying individuals that are investing with you folks.
Yeah, so our target's 11 to 13%, right? So I think for people that are, haven't been exposed to private real estate, right? It's not an uncommon number to potentially achieve. So basically especially in Ontario, there are significant lifts available, right? In terms of value lifts, right? And so we're going after buildings where, the rents are under market by $1,000 in some cases. So that provides a ton of equity relief. The other thing that we're doing in a number of our buildings is not just relying upon, turnover and growth of, rental rates on existing units, but we're adding units too. So we have a number of projects where, 15 units are turning into a 20, and 18 to a 23. What else do we have? We have, a smaller one, a 12 to a 15, right? So that bump, we're not worrying about tenant turnover there. We're adding rental stock. And as you know, in Canada in general, but Ontario more specifically, that's what we lack. And that's why rent rates are soaring, right? So when we find buildings like that, those are, I wouldn't say call them home runs, but they really help. They really help the valuation.
Absolutely. For sure. So Mark, how do people in the States, how do people in Canada, how do they get in touch with you, get some money to you? And again, with what you folks are doing, I love the idea, real estate with, the tax incentives, that is a whole other conversation that we could talk about. Yes. How that ownership, the governments, doesn't matter where you are in the world, they want you in business. If you're going to be the solopreneur and you're going to go and get a job every day and you're going to make a paycheck, they're going to take it out of you. So when you have opportunities to jump into some of these real estate investment trusts or independent, however you want to do that, there are so many benefits, and it is a wealth generation and wealth creation mechanism. Mark, how do they get in touch with you? How do we send some money to you and close us out here today?
Yeah, I appreciate it. Thank you. So peakmultifamily.ca, right? So our website has a ton of information. You can fill in one of the forms there. My contact's, probably there as well, or is there as well. LinkedIn, pretty active on LinkedIn and a lot of social media platforms, just again, sharing information, right? Share information, education. So happy to chat, or at Mark in my email, mark@peakmultifamily.ca.
Well, that's awesome, Mark. I appreciate you coming here today. Folks, real estate, it's never going anywhere. They're not making any more dirt. So if you can put a box on it and you get someone to pay the bill for you, that is a mechanism for success. Get in touch with Mark, get in touch with Peak Multifamily, see what they can do for you. And it's conversations like this. Mark's out there trying to teach people. You didn't have Uncle Tim or Tom that was going to sit there and walk you through this as a young person. You don't know that this exists. So share this. Get people, the young people in your life, show them this. Show them that there are different ways to go and make money and pay their bills and live a lifestyle that they want to than going and doing the 9 to 5. From me, folks, Mark, thank you so much for joining us, pal. I appreciate you. Let's make some money together, folks.